Okay. Hi, guys. Good morning. So, today we're going to break down what is happening in the world of private equity, and we're going to break down kind of the first chapter of the book, Defending Main Street, which we want each and every one of you guys to read. So, it's in your inbox. Be sure you start reading it. We're going to be covering probably 2 chapters in each go forward session. So, I'm going to jump all the way to chapter 1, which is all about, part 0, it's called the roll up revolution. So it's all about kind of where these roll ups came from, how this idea of buy and build really started to come about, and how we got to where we are today, right? So some of kind of the crazy stats that I think a lot of you guys already know. There's 4,000 private equity firms in the United States. They have $7 trillion of dry powder under management. So these guys get money from pension funds, endowments, universities, nonprofits, anywhere you can think of that has large kind of chunks of money. Sovereign wealth funds, it's how these private equity firms raise money. There's even a new notion which is coming into market quite soon, that 401ks. So your parents' 401k, your 401k will now potentially be allowed to be invested in private equity. So really kind of interesting dynamic with what's happening. But private equity, again, $7 trillion of dry powder under management. And a lot of them, or actually all of them, make money on this concept called 2 over 20. So they charge 2% for assets under management. That's not cash under management, that's assets under management, which is why we hear a lot about how incentives are not necessarily misaligned, but definitely questioned. Because if they are marking up the value of the asset, they're charging 2% of whatever that marked up price is for that asset. So they charge 2 over 20, 2% annual management fees. This is not a one-time fee. These are annual management fees. And then they get 20%, at minimum 20% of the profit. Certain funds that are really, really kind of proven racehorses, we've heard, are negotiating much more aggressive deals with their LPs, where they might be charging 30%, 40% once certain returns are realized. So really kind of crazy how the private equity kind of flywheel makes money, and where they've really kind of built their chomps, where it's really enabled them to do more with less, are these leveraged buyouts, right? So the concept is put as little cash into these roll-ups as possible, and then use debt once you get to a certain scale to then buy more assets and get bigger. So they're running these playbooks, which we really call, you can call them roll-ups, you can call them buy and build, you can call them platforms. It really is this roll-up revolution. This is their kind of secret to making money, is this idea of 1 + 1 = 4. So if you take an existing business that maybe is doing 5 million of EBITDA, let's just use round numbers here, but an existing business doing 5 million of EBITDA, let's say that business is suddenly worth 10 times. So we'll do the math on that, right? 5 times 10, $50 million enterprise value. Now let's say that $5 million EBITDA business acquires a business doing 1 million of EBITDA. And they're going to pay, because it's smaller, but again, they have the efficiency of scale, 1 + 1 = 4. They're going to buy that $1 million EBITDA business, let's again use round numbers, for 6x. So now they've paid $6 million for an asset that on their books, day one, is worth 10 times. So they made $4 million in enterprise value for a $6 million piece, $6 million spend. So they more or less doubled their money without doing anything, without integrating it, without creating back-end synergies. They literally doubled their money on paper day one. Then they do this again and again and again and again. And let's say they bought a $600,000 asset and they paid 5x for that, right? They literally doubled their money, right? That $600,000 asset that they paid 5x for, so they paid $3 million for that. On their balance sheet, that's suddenly worth 6 million enterprise value. So they've taken these very, very big TAMs, big industries, 100,000 mom and pop businesses, HVAC, plumbing, electrical, pest control, landscaping, restoration, fire protection. All of these very, very large industries that have tens of thousands of mom and pop players, and they've started deploying these buy and build strategies. Beyond just kind of the EBITDA arbitrage that they're making on paper day one, obviously there's synergies in the back end. Synergies with HR, synergies with benefits, synergies with marketing, synergies with client acquisition costs, synergies with labor deployment, right? Major synergies if you're looking at a HVAC or landscaping or pest control business where you're really just focused on route optimization. So those are kind of the levers that a lot of these PE guys are pulling, right? They're doing buy and build. They're then doing de novo, which means kind of organic expansion. And then they're looking at how do we actually, through de novo, through organic expansion, kind of get bigger, right? So you see this playbook executed again and again and again, where they might take an HVAC business and suddenly say, okay, this HVAC business has the same end user. It's got a residential house or a commercial property manager. This HVAC business should suddenly start offering plumbing and start offering electrical, because on the other side, you want less vendors to deal with. So that's really the approach that they're taking. And as we get into this chapter, I talk a lot about why private equity has just fallen in love with essential services, and it's why we're so focused on essential services. So they love essential services for a couple key reasons that we did already talk about, but I'll just double click on this, right? So they love the recession resistance, right? And we're hearing a lot of talk about kind of anti-AI revolution, right? People are trying to hedge their bets against technology, hedge their bets against kind of what's happening with the wild world of AI and tech multiples being out of whack. They love the fragmentation, right? Thousands of independent mom and pop operators. There's no single national leader in any of these verticals. It's not like retail. It's not like telecom. It's not like oil and gas, right? If you look at telecom, you've got three major players. If you look at retail, Walmart has a 20 to 30% market share in every category they play in. That's not the same with pest control. That's not the same with HVAC or plumbing. There's probably no one company in any of these essential service verticals that have more than 1% market share, right? So it is completely fragmented. They love the recurring revenue, right? So these service agreements, maintenance, inspection contracts, right? This predictable revenue is what really allows them to underwrite these businesses the same way they would putting it into a bond, right? They know this revenue is going to be there every single year. And if there's less recurring revenue, it's why you see kind of a hit in the multiple. If there's project-based revenue, they're going to pay less for it. They love the labor moats, right? This is not retail. This is not kind of minimum wage talent doing it. There is some sort of skill required, right? These skills are hard to automate. You're not going to have an HVAC technician be replaced by a robot today. So the labor moat is really exciting. They love the margin expansion opportunity. So in all these industries you look at, whether it's landscaping or fire safety or security and alarm or pool, any of these essential service industries that we cover, there's an opportunity for margin expansion. And that margin expansion does not come from just raising prices. That margin expansion comes from more service lines, right? So cross-selling and upselling the customer base. It comes from buying power with the vendors, right? So if you are an HVAC company and you suddenly are spending $10 million a year with American Standard, your pricing is going to go down. American Standard, you're not going to accept that American Standard is going to charge you the same price that they did when you were spending $100,000 a year, right? So that margin expansion comes from a lot of different ways. It's not just HR. It's absolutely not cutting wages, right? This idea of cutting wages is not something that private equity is trying to do when they're doing these buy and build strategies. They want to retain talent, they want to grow talent, they want to promote talent, and they want to get margin expansion through other schemes. And then the EBITDA arbitrage, right? So again, you're buying smaller companies that trade at 6 to 8x, you're combining them into one entity, and then suddenly overnight, this one entity is worth 12 to 15x. So the math is really there, and there continue to just be incredible trades in these sectors. Just last week, a large HVAC business that did that acquired 20 plus businesses, grew the business to over $150 million of EBITDA, traded to 18x. And there was not one business that was 20 or 30 million of EBITDA. These were all $5, $10 million EBITDA businesses that got added up over a period of time. So the 10 plumbing businesses, each doing 2 million of EBITDA. This is the example that I break down. That's $16 million per company to purchase it. You spent $160 million buying those 10 plumbing businesses. Now the combined entity is doing 20 million of EBITDA. So 20 million times 12, that's $240 million of enterprise value. So that's an $80 million paper gain created not through growth, but really through reclassification of what books these entities are sitting on. That's the concept of EBITDA arbitrage. So I'm going to open it up for questions on who has kind of any kind of feedback or Q&A on the topic that we just covered.
Yeah, I had a quick question. For the margin expansion, what do you think is the biggest difficulty a private equity would face in that specific strategy?
With margin
Yeah.
expansion, I think that it's proven that there's not a ton of difficulties, like very easy low hanging fruit. Again, I would say that these platforms go after the lowest hanging fruit. So the lowest hanging fruit is cost of materials, right? You're putting more pressure on your vendors. Cost of materials is the number one opportunity for margin expansion. You're going to those same vendors that you now have more buying power with, and you're getting them to give you lower prices on those goods. Number one is pushing your vendors, putting pressure on your vendors. Number two probably comes from just basic like back office infrastructure, right? You're saving money on insurance and benefits, and you don't need, an AP AR person for every single business. You can consolidate that. So like back office roles are definitely getting consolidated. And then you look at cross selling as other opportunities, right? You're introducing new service lines, new technicians, new kind of playbooks, right? We've seen a lot of HVAC, plumbing, electrical businesses get really good at generator install and service, right? So they've got a playbook for how do they go to those 10, 20,000 residential customers and start selling them a new service line that isn't that complicated to install and service. Who else has questions?
I had a question.
Go ahead.
Um, I wanted to ask if you could re-explain that the first concept that you were talking about, that when a private equity acquires a company, how does the book value automatically double by not doing anything? I wanted to just like clarify on that.
The book value doubles because it's a smaller business that's valued at 5 or 6 times, right? Let's just say single digits. And then the book value of the combined asset is typically, they're underwriting towards a double digit multiple. So the overall enterprise value of the platform is greater when combined versus looking at it as an individual asset by asset level. Hopefully that helped answer the question. So some other things to look at, I'll kind of keep going through this chapter. So some other things to look at is kind of what's the timeline of a roll up, right? So platform launch, right? Typically a platform can be launched around a core base business that has that infrastructure, that has that management team in place, that has those systems and processes, and is doing at least 3 million of EBITDA. Sometimes we see groups going less, but in our world, which is the lower middle market, we are not a middle market investment bank, right? We're lower middle market. So, our world are businesses that are really, sub 20 million of EBITDA, I would say is considered lower middle market. But they're looking for an existing standalone asset that is doing 3 million of EBITDA to be the basis for the platform. That's kind of timeline number one. Part two is the add-on phase, which is starting this buy and build strategy. So adding on other assets in adjacent markets that maybe are founder led, local, in a market that the core business wants to expand into, and typically significantly less sophisticated financially. So they're able to pick up these add-ons for mid to low single digits, where they picked up the initial platform for maybe high single digits, low double digits. And in this add-on phase, they're typically looking for businesses that are between 500,000 to 2 million of EBITDA. So smaller, and again, they're getting that book value that we talked about day one. Part three is really the integration and optimization, right? Centralizing the back office, professional management team, software, obviously kind of the tier one software that most of these essential service businesses are using is Service Titan, streamlining pricing, marketing, new service lines, de novo expansion. And then typically after 3 to 5 years, and again, the hold period does really have to be for 3 years at a minimum, due to some tax benefits they receive. If they sell earlier than 3 years, they lose those tax benefits. But after that 3 to 5 year period, where EBITDA has at least doubled or tripled, they then look to sell the combined platform. So again, the way to look at it is a maximum hold time that a PE firm's underwriting is 10 years. That's the maximum that they're underwriting. They're typically trying to get in and out of these businesses in 3 to 7 years. They look at it as the first 5 years is buy, build, add on. The next 5 years is cleaning it up, proving value, proving efficiency of scale, and then within that 5 year period, they have time to flip it. So they're always interested in flipping it, right? Once they're past that 3 year hold period, they can flip it. But they're typically looking at a 3 to 7 year hold period on average. And again, they want to get their LPs their money back, right? So there's kind of a whole line of groups behind this buy and build strategy. So you've got the limited partners, which we refer to as the LPs. So these are the pension funds, insurance companies, university endowments, wealth funds. These guys are not venture investors. They're really looking at the private equity firms to beat the market. That's what they're looking for. They're not looking for a 20, 30, 40% annual return. They're looking for a 10 to 15% annual return. That's what they're underwriting. Can they get a 10 to 15% annual return? You've then got the general partners, again, who are the private equity managing partners themselves. They're also investing capital alongside. Again, they're making the 2/20 that we talked about. You then have the debt providers. So again, this is where we talk about this concept of a leveraged buyout, which the private equity firm has a set amount of equity on hand, right? But they can borrow against that and apply not 2 times leverage, not 3 times leverage, 5, 6, 7 times leverage, right? If the business can support it, they're fine to take on the debt. And you've really got to do the math of like how much debt can the business support without killing it. So they're not trying to kill the business, and you hear horror stories of PE killing the business. Those were where they get a little above their skis, and maybe they're calling it that the investment's not working out, and they need to get their money back via kind of these debt verticals or these debt vehicles. But more than likely, they're looking at a debt provider and a debt arrangement where the business can still invest in growth and succeed. So they're really looking at it from like a debt servicing standpoint. So I would say rule of thumb, prime is what they're, maybe prime +1 or prime +2 is what they're investing in, or what their borrowing costs are. So what's Wall Street Journal prime today? Wall Street Journal prime today is 6.75%. So let's assume their borrowing rate is 9%. So we can do the math on that. Let's say we have a 5 million, we're going to use the same example that we've been using. Let's say it's a $5 million EBITDA business, $5 million EBITDA business, times 10, $50 million enterprise value. So let's assume that we took out 50% in debt. So we took out 25 million in debt to fund the acquisition, right? The private equity firm borrowed 25 million. Now let's do the quick back of napkin math on what it costs us to borrow 25 million. So if we're borrowing 25 million, it's going to be a 10-year payback period. Again, I'm going to just use round numbers. Well, we won't use round numbers. So 9% borrowing cost. So my debt service, my interest only, is 2.25 million a year. So you could do an interest only deal where you're not even paying the kind of amount back, right? You're just paying interest only. So your debt service, 2.25 million a year. But again, you're making 5 million a year, so you're not going to kill the business by servicing the debt with 2.25 million a year. They're also underwriting that the business is going to grow, that the debt service, isn't necessarily going going to hurt the business. And they have to continue to refinance. So they might be doing like a 10-year interest only. It's just expensive interest, again, the 9% that we're talking about. So $2.25 million a year in debt service. But again, a $5 million EBITDA business, that's not going to kill it. So the debt providers and then the operators, right? So we're all these private equity firms are bringing in operators, or they're keeping the founders in place and say, we're going to go operate against this buy and build strategy. So two types of roll-ups: financial roll-ups, pure play, buy low, combine fast, sell high, and then strategic roll-ups, where again, we're moving slow, culture's intact. I think those are fairly similar. At kind of the middle market, and I would say kind of non-middle market is where you see kind of pure financial roll-ups being done, where they really try to integrate two businesses. I mean, if you look at some famous ones as of late, Kraft Heinz is a good example of a pure financial roll-up, right? They're literally just combining the two businesses, combining fast, selling high, bringing in professional management, integrating very aggressively. Most of the lower middle market are these strategic roll-ups, right? So they're not moving super fast. Again, they have a 3 to 7 year hold period in mind, and that's really what's allowing them to get kind of the outcomes that they're able to get. Any questions on what we talked about?
Yeah. So when we talk about private equity firms and them buying companies, as far as when it comes to building the platform company to kind of eat the smaller companies they acquire, are they targeting specific companies that have a strong system in place already to be the platform companies, or are they creating another entity to be that platform company, or is it a mixture of both?
It's a mixture of both. I would say the preferred path is there's an existing, again, look at it like renovating a house, right? They want to buy a platform that has good bones, right? It's much easier to buy a platform that has good bones. Private equity is typically not in the business building business, right? They're in the business optimization business. So much easier to do a remodel than new construction, you would think, right? Sometimes new construction is easier, but you would think that doing a remodel is easier. So they're really looking for good bones that exist, some sort of management team, some sort of systems processes, some sort of sticky client retention moat, right? Good proven service lines, pricing know-how, good founder that's built kind of a good culture and has a good reputation. And they're looking for something that they can build off of, right? That they can execute this buy and build strategy around. Hopefully that answered your question.
Yeah, it did. Thanks.
Yeah, I had one more question. I've noticed some private equity firms, specifically in healthcare, do seller financing. So do you think that would be implemented in the essential services, or it just depends on the business itself?
I would say seller financing is towards the very, very low end of the middle market. It's not something we see in like true lower middle market. Seller financing is typically when you're using a search fund, when you're using, uh, when a search fund's going after a business, when you're, working with an SBA partner. Like it's not something we see typically in the true lower middle market. Um, Seller financing isn't always a bad thing. I would say I'm not going to advise my client to seller finance an operator that is questionable. Like I would not advise my client to seller finance a search fund. But seller financing can be a good thing potentially because of the tax savings, right? So, you're paid annually that money back. You're not paid it in one lump sum. So let's say there is a 3 to 5 year hold period. It's going to bring down your tax burden substantially. So that's where seller financing could be a good thing. It's why rolled equity is typically a very good thing. Anything else, guys? Nope. Cool. Well, we will resume next week on Monday with the next chapter, and then we'll do some more Q&A. Thanks, guys. Have a great week. Again, for this upcoming week, build conviction around 10 more businesses. So that's the workflow again. 10 new businesses by this time next week. Okay. Thanks, everyone. See ya.